Welcome to How to Make Money in Stocks with Investors Business Daily, featuring market commentator and host of the IBD Market Wrap, Amy Smith, and Matthew Galgani, host of the IBD Stock Analysis and editor of the IBD Extra newsletter. Tune in each week as we use history, not hunches, to help you stay safe in today's market and get in early on tomorrow's winning stocks. Now, here's Matthew Galgani.
Welcome, everyone, to another episode of How to Make Money in Stocks with Investors Business Daily. We want to let you know that the June issue of the free IBD Extra newsletter just came out this week, and in there we talk about 3 simple ways to manage stock market risk. And we also take a look at how the first 5 months of 2015 compared to the first few months in prior years within this bull cycle.
And in the show today, we're going to talk about why return on equity and profit margins are so important. But first, let's take a look at the market. Well, the market remains choppy and range-bound. The 2 things, of course, that investors are monitoring closely are the Fed and Greece. Now, we saw the S&P and the Dow both dropped below their 50-day moving averages, and Greece has postponed its payment to the IMF. Now, what spooked the market on Friday is that hiring surged and the U.S. gained 280,000 jobs in May. This is good news, but it also increases the odds that the Fed will increase interest rates probably in the fall. We had job increases in high-tech firms, healthcare providers, hotels, home builders, and retailers. They all added workers. Only the energy industry group, which is coping with lower oil prices, saw a sizable decline in jobs, according to the Labor Department.
And one of the things you want to keep a close eye on in this situation is the distribution day count. Right now, it's been elevated. It's not quite in the danger zone yet. But one thing that is of concern, and Paul Whitfield mentioned this in the big picture on Friday, is that the number has gone up in a short amount of time. For example, we now have 4 distribution days on the NASDAQ, but if you go back to just May 28th, there were only 2 on the NASDAQ and there was 1 on the S&P. So the S&P has also added quite a few in just a short amount of time. And there is a bit of a dichotomy. You talked about the S&P now is down below its 50-day, but the NASDAQ is still above it. So there's a little split between the 2 major indexes. So we'll have to see which one ends up pulling the other one up or the other one pulls the other down.
Well, and we have earnings which don't really start up again until July, and that usually adds some kindling wood to the fire, or it could put the fire out, One of the 2. We had some very interesting newer IPOs that debuted on Friday. We had Evolent Healthcare, that's EVH. They provide software to help hospitals improve the way patient care is delivered. And we had David's Tea. This is a Canadian company. It's DTEA. Keep your eye on these 2. They both made pretty strong debuts on Friday. Upcoming is another IPO called Fitbit. The ticker symbol there is FIT, and we'll have to wait and see what happens with that company when it comes public.
As we've been saying for quite a while now, the market has been choppy and range-bound, and in this kind of market, it can help to focus more on weekly charts rather than daily charts. And Arusha Peiris, who was on the show a couple of weeks ago, made that comment as well. And if you look at stocks like eBay or CyberArk, and the ticker there is CYBR, you can see how the daily chart shows a lot more volatility than the weekly chart. So looking at the weekly, if you're already in the stock, or if you're trying to get a sense of how that stock is doing, that can give you the longer term perspective. And if you're in the stock, help you sit tight when you should rather than be spooked by some daily volatility.
Retailers posted some sluggish May sales. The malls are not that busy, Matt. Costco was a little flat. Gap was a little bit flat. Millennials are spending more on experiences than they are at the mall. Some teen retailers are having trouble like Aeropostale and Abercrombie. But some stocks like Ross and TJX are doing well. Also, Home Depot and Lowe's, in terms of earnings and same-store sales, are doing well.
One other thing to point out is that Caesarstone, the ticker is CSTE, it broke out this week, but it's still too early to tell if it's going to be the kind of breakout that stumbles and stalls like we've seen a lot of recently, or if it's really going to gain ground. If you look at the volume on the day of the breakout, it was 30% above average, which is not bad, but a little bit below what we're looking for. And then the next day, it dipped below the buy point, but it did manage to come back. So the point there is that with these kind of stocks and these kind of breakouts in this market, if you do buy, keep them on a tight leash if the trade doesn't work out.
Are you new to investing or been doing it a while but not getting the results you want? Either way, the book How to Make Money in Stocks Getting Started by IBD radio show co-host Matthew Galgani can help. Step by step, you'll see how to set up your game plan and routine, how to use simple checklists to find winning stocks, plus online videos and action steps enhance what you learn in the book. Get your copy of How to Make Money in Stocks Getting Started. Visit investors.com/radio show. That's investors.com/radio show. Now, back to How to Make Money in Stocks with Investors Business Daily.
Today we want to talk about the difference between cyclical stocks and growth stocks. The basic concept is that there are some companies, some stocks, that are more affected by changes in the overall economy than others. So in a good economy, these stocks will go up, but in a bad economy, they're probably going to get hit pretty hard. So although sometimes the difference is somewhat subtle between cyclical and growth stocks, it helps to understand that concept and the difference between the two.
And you know what? If you don't understand an investing term, kind of an interesting place to go is a site called Investopedia, if you've never gone there. And they have a good definition of what a cyclical stock is. You know, there are ups and downs in the overall economy, as Matt said, and cyclical stocks are going to be more sensitive to discretionary spending by the consumer. You know, if the economy's booming and you're real secure in your job, Matt, and you're feeling good about the kids and the house, if you're not worried economically, you're going to go out to eat more. You're going to spend more money perhaps at a department store on clothing. You're going to go out more. So all of that discretionary consumer spending is important. And that's the reason why it is an economic indicator that we do pay attention to when those numbers come out.
Sure. And if you're seeing, for example, in a strong housing market, all of the home builders are moving up, that's a positive sign that will also have a ripple effect on other related industries.
And we saw, in fact, recently, right, in the last couple of years, you've seen the secondary housing market, people buying second homes, has been an incredibly strong market. So what does that mean? Well, people have had some extra cash and they've actually bought another vacation home. That was an indication that the consumer definitely was willing to put that money out there.
And you also have to keep in mind that the stock market is a very forward-looking beast. So, for example, with housing and with home builders, those stocks will typically start to move up when the news is still...
It still looks pretty bad.
Still negative, still looks kind of bad. But the signs down the road for these institutional investors is that the economy will pick up over the next few months, maybe 6 months out or something like that. So they're going to start getting into those stocks at that point, knowing or hoping that the economy does pick up and these stocks start to take off. But at the same time, when these same institutional investors start to look ahead and see, well, maybe this cycle is coming to an end, the economy is going to turn for the worse a few months down the road, at least in their estimation, then they're going to start easing out of those kind of stocks. So it's important to understand that and understand the cyclical nature of companies that are in industries like autos and hotels and airlines and restaurants, as Amy said.
Yeah, as Matt was saying, these industry groups, what makes a cyclical stock? Well, automobile manufacturers, airlines, furniture, steel, paper, heavy machinery, hotels, and expensive restaurants are really good examples of cyclical stocks. When the economy booms, as it did in the go-go 90s, you know, people were buying all kinds of things, cars, plane tickets, you know, everybody was making a ton of money in the stock market.
Life is good. Right, but that can change. And for example, back in 2008 and into 2009 and beyond, of course, we were in a financial crisis, entered into a very severe bear market. And where did these institutional investors shift their money? They have to do something with the billions of dollars that they're sitting on. And one place that they started to move their money was into discount stores like Dollar Tree, Dollar General, TJ Maxx, Ross stores. Mm-hmm. You go back and look at that time period, look at a monthly chart or maybe a weekly chart, and you can see how those particular stocks started to do very well because they are cyclical too. And the institutional investors understood that in a bad economy, when people are on tighter budgets, where are they going to shop? They still have to shop, but where are they going to go? Well, they're going to go to the discount stores.
So how can we predict this, Matt? Are we in the predicting business? No, no,
Definitely
no.
not.
You know, predicting what company is going to do well if there's an upswing in the economy is very difficult to do. So all we have to do is take a look at the chart and take a look at the volume. You know, we like to look at the fundamentals, yes, of course, but the technicals tell us when to get into a stock. And then, you know, normally you'd have to do tons of research to try to figure out, 6 months from now, this industry group might be doing better, or this industry group might be doing. We don't have to worry about predicting or guessing. Now, here's something. Cyclical stocks are very interest rate sensitive. Data shows when the interest rates are falling that these cyclical stocks will do well. But conversely, when we have rising interest rates, cyclical stocks typically don't do as well. And that's why there's been all this discussion lately about the Fed. When are they going to raise rates? What do we see in the economy? What's the jobs report? Because all of this is going to factor into how quickly we get interest rate hikes and how much they actually raise the rates.
And on this topic, you should read an article by Paul Whitfield, which we'll link to on our website. It's an Investor's Corner article on this idea of cyclical versus growth stocks. And in there, he uses two examples. One is Winnebago, which makes the big RVs, and then Apple is the example he uses of a growth stock. So a $100,000, $250,000 sweet ride recreational vehicle, an RV, is not something you're going to buy. At least a lot of people are not going to go out and buy that kind of vehicle when the economy is terrible. Maybe they got laid off or they're fearful of what's going to happen to their retirement fund. In that kind of environment, a company like Winnebago is going to get whacked.
And you know what Winnebago is to me? This sounds like the biggest nightmare in the world. I've mentioned this before on the show. I can't imagine taking a family, shoving them all into 500 square feet or less,
Right.
and say, let's go on a vacation, and we're going to be around each other 24/7.
Could be a recipe for some real disasters.
I'm surprised there's not more deaths, Winnebago deaths. Put the family in there. Who dies first?
Well, on that note, if you've never seen it, there's a really funny documentary called Winnebago Man. Now, I have to warn everybody, there's a lot of expletives in that, but that's kind of the basis of the whole story of this guy who's making Winnebago commercials just loses it. It's very funny.
Anyway, but you're right. You know, Winnebago, the point is in 2003, it made an incredible move for about 10 months, and then it did stall out, and it sagged back down. And that is classic cyclical action, okay? As soon as the party's over and the economy starts to pull back, stocks like this will run into trouble.
Now, you don't necessarily have to hard code every stock that you're looking at or every stock that you own into a category of, is this a growth stock or is this a cyclical stock? Sometimes that distinction can be a little bit subtle. But the good news is you can tell a lot about this topic by following the industry group ranking. That is really one of the keys, because when one of these cyclical or growth stocks are moving up, the industry group as a whole may be moving up as well. Typically, that's going to happen when you get a flood of stocks in that same sector or in that same industry group moving higher. Of course, the group itself is going to move up. So one way to track if an industry group or this group of cyclical stocks like home builders or like auto dealers, for example, watch the industry group ranking to see if that's moving up or if it's moving down.
And truthfully, we could really make this argument back and forth. Is that actually a cyclical move or is it actually a growth move? Because when you think
Right.
about it, right, I mean, it's kind of a matter of semantics, because when the airlines were moving higher, it was because we had the fuel prices coming down, which allowed the airlines to make a bigger profit. And so all we have to pay attention to is who's making a lot of money. Did Winnebago have a great quarter? Did they have blowout earnings numbers? Then that will be earnings, and it will show up on a chart, and we'll see it with the volume. So technically, we could say cyclical actually does turn into a growth name, but it may also retreat as soon as the circumstances change.
And one distinction that Paul points out in his article about this is a classic cyclical stock will have a nice run when the economy is strong, but give most, if not all of those gains back when a recession hits and the market falls apart, as opposed to a growth stock. And this is not all growth stocks, but especially these super stocks like an Apple or something of that nature, they'll tend to not give it all back and hopefully have the strength to continue to pump out strong earnings growth, and then when the market and the economy pick up again, continue higher from there.
And we have the industry groups in the newspaper listed. There's 197 industry groups, and we sort of look at the top 20. The reason that's in there is because a lot of your more successful companies will be in those top industry groups. Yes, we do have stocks that will be from another industry group that maybe is a little bit laggard, but on the whole, you will find many of your successful stocks in those top groups, and that's why it's in the paper every day. You also want to look for industry groups that may be shifting, that may be coming into play. In other words, maybe they were laggard industry groups, but they're moving up in the rankings, and that's what we're getting some sector rotation. So all these things we try to pay attention to, and that's why it's in the paper.
And following those industry group rankings regularly is a really easy way to get in sync with the cycles for these different categories, these different industry groups or these different sectors. For example, you can look at the home builders industry group or the chip makers or the airlines, as you mentioned earlier. Seeing how those rankings are changing, they're either moving up or they're moving down, and then going into, say, Stock Checkup on investors.com to see what are the top 5 stocks specifically within that industry group. How are they doing? Are they moving up? Are they pulling back? That will help you stay in sync with these cyclical stocks.
So we're going to talk a little bit about return on equity. There was a very good article here written by Vincent Mao in Investors Corner, and he talked about strong returns on equity, and some of these companies that you will have heard of and that have done very well would be like Papa John's, Valiant Pharmaceuticals, Regeneron, Celgene, Manhattan, and the list goes on. There are several here, but we can see that the return on equity for all of these is very, very strong. Now, the minimum number that we look for is 17%, but these numbers are huge, Matt. Instead of 17%, we have rankings that go from 34 to 66% return on equity.
And one of the reasons we pay so much attention to return on equity is that it really is one of the key distinguishers between so-so companies and those that are much more efficiently run. And that's important because, as we always talk about, earnings growth is one of the biggest factors you want to look at in a stock. And the ingredients to creating big earnings growth include return on equity, profit margins, which we'll talk about a little bit later, as well as sales growth. Those 3 things have to be in place in order to generate big, long-term, sustainable earnings growth. So when you see a company that's got 1, maybe 2 quarters of decent earnings growth, go check the return on equity to see how strong that is. And you'll find that in IBD Stock Checkup on investors.com.
And what's kind of interesting on these companies that have very strong returns on equity, I'm noticing that some of our other data is also extremely strong. You can take a look at the composite rating, the earnings rating, the relative strength, and the accumulation distribution. So companies do pay attention. You know, that the analysts that dig through all of this data, they do pay attention to all these very, very top performing companies that have extremely strong fundamental ratings. And as Matt said, the return on equity is important because it shows how efficient a company is with the shareholders' money. And the more efficient the company, the better it is for the shareholders also.
Right. And again, it is one of the key ingredients to strong, sustainable earnings growth. So you'll find that a lot of the companies that have multiple quarters of strong double-digit, maybe even triple-digit earnings growth tend to have strong returns on equity. And IBD actually has a simple way to track this concept of the ingredients of big earnings, and that is the SMR rating, which stands for sales growth, profit margins, and return on equity. So we look at those as a whole to give you an idea how strong that particular company's recipe for growth is.
Now, in the case of Papa John's, what's kind of interesting here, return on equity of 65% in 2014. And that was up from 43% in 2013. And the return on equity for the company in 2012 was 33%. Those are just huge numbers, and they're increasing. Papa John's has had a great move. It's been kind of on an uptrend for years. Now, here's one thing to note, though. It is highly leveraged. So they do have a lot of debt. They have long-term debt. So just because the company has this high return on equity doesn't mean that you want to ignore some other things. And of course, debt is something that we do pay attention to.
Absolutely, because especially in a time like now where it's possible that fairly soon down the road, interest rates could go up. And maybe they're going to go up slowly, but if you get a dramatic or a significant increase in interest rates, that's going to cost a lot more to service that debt, and that could hamper cash flow as well. It's going to eat up more of the company's money just to pay back that debt. So it is something you want to pay attention to. Now, back to the SMR rating really quickly. A lot of times when you're going through a stock's fundamentals and you're trying to check off all the things on the checklist, make sure it has everything we're looking for, you're going to find a blemish or two. And maybe one of the things you find is instead of the 20% or higher quarterly sales growth that we look for, maybe you're going to find something a little bit short of that. Maybe it's 15, maybe it's 10, something in that range. One thing that potentially can help mitigate that in the case that everything else is looking good. But one way to mitigate that is to look at that SMR rating. So maybe sales growth is a little bit below what you'd prefer to see. But you look at the return on equity, it's strong. The profit margins are strong. So as a whole, the SMR rating is, let's say, an A, an excellent rating for that company. That can help mitigate the fact that sales growth is a little bit below what you'd prefer to see.
Now, one thing I know that Bill has taught in many of the workshops, and he's mentioned to both Matt and to me, is that if a company doesn't have a really strong return on equity, take a look at that pre-tax margin number, okay? You want one of the two of those to be really in good shape. And of course, when we had Lee Tanner on the show, he has a little thing that he does where he combines the return on equity and the pre-tax margin and puts them together.
Right, and he's looking for 50 or higher on that. So for example, if you had a 30% return on equity and a 20% profit margin, that gets you to 50, and that's the benchmark that he looks for to separate the great from the just kind of good stocks or companies. And on that note, Scott Stoddard did an Investors Corner article about profit margins, and we'll also link to that. Now, one thing about profit margins is they vary dramatically by industry. So, for example, a software company will tend to have a much higher profit margin than, say, a grocery store. Grocery stores and discounters famously rely on razor-thin margins, but they make up for it on volume. So don't expect to find a 25% profit margin in Kroger's. They're not going to have that number because it's not that kind of business. So compare apples to apples, not apples to oranges.
And that goes for earnings too. You know, a big company like a Kroger's is not going to produce earnings up 383%. That's just not going to happen. You're going to see those numbers a lot smaller. Sometimes if you watch one of my market rep videos or one of Matt's videos, you might be a little confused because we mentioned the earnings in the most recent quarter, which look pretty decent for that particular industry group.
So to kind of wrap this up, when you're looking for stocks to buy, you want to see stocks that have big earnings growth, preferably accelerating earnings growth. And that should be for several quarters, not just one quarter. Then you want to make sure that they have the ingredients to keep that going, to keep that trend alive. And one of the things to look at is return on equity. You also want to look at the company's profit margins, and you want to look at sales growth. Those are the three key ingredients that will drive earnings growth. And it's easy to do. All you have to do is go to IBD Stock Checkup, punch in the ticker. You'll see if the stock gets pass or fail ratings for those particular categories. And while you're there, let's say they fail. It's not what you were looking for. Go up to the top of IBD Stock Checkup and look at the top 5 stocks within that industry group, and you'll see if there's a better stock in there. And going back to what we talked about in the earlier segment, look at the industry group ranking, which is also in there, and start tracking that. Then you can see, for example, if it is a cyclical stock, is the cycle currently moving up, or are we entering into a down cycle? So this is how all of the pieces fit together, and IBD Stock Checkup makes it easy to track.
For decades, people have been using the CanSlim investing system to build financial peace of mind. And now you can see exactly how they do it and how you can too. In How to Make Money in Stocks, Success Stories by IBD radio show co-host Amy Smith, you'll see the life-changing journeys of both new and experienced investors, how they got started, their early mistakes, and biggest successes. To get your copy of How to Make Money in Stocks, Success Stories, visit investors.com/radio show. That's investors.com/radio show. Now, the final segment of How to Make Money in Stocks with Investors Business Daily market commentator Amy Smith and Matthew Galgani, editor of the IBD Extra newsletter.
There is a good article that you should read. We will have it on our website. It's How You Can Win in a Choppy Stock Market. And Paul Whitfield talks about Disney. We go through 2013 as well as the gains that it made in this year, 2015, from a gap up February the 4th. And that stock is up 21% in 149 days.
And you can get that article and the other ones we mentioned earlier in the show, as well as get the IBD Extra newsletter June issue, all at investors.com/investing show.
See you next week, everybody.
You've been listening to How to Make Money in Stocks with Investors Business Daily, featuring Amy Smith and Matt Galgani. For more stock ideas and investing strategies, and to subscribe to the free podcast of this show, log on to investors.com/radio show. That's investors.com/radio show.